Hey, welcome back to Compounding Quietly. Most investors stop at the dividend yield, but the companies that buy back their own shares are sending a different kind of signal. DIVB is built around both of those signals, and understanding the difference changes how you evaluate an income ETF. Let's get into it. There's a pattern that repeats itself in almost every market cycle. An investor starts looking for income ETFs. They filter by yield. They pick the one with the highest number. And 6 months later, they're wondering why their position isn't growing the way they expected. The yield comparison is the most common entry point for evaluating income funds. And it's also one of the most incomplete, because yield is a snapshot. It tells you what the fund paid recently, divided by its current price. It doesn't tell you whether the companies inside are growing. It doesn't tell you whether they're strengthening their balance sheets. And it doesn't tell you whether the payout is sustainable over the next 5 or 10 years. That incomplete picture is why so many investors end up in funds that look attractive in the short term and disappoint over longer holding periods. So the question isn't which ETF has the highest yield right now. The question is, what kind of shareholder return am I actually being exposed to? And is that return sustainable and growing over time? That's the frame you need before DIVB makes any sense. DIVB, the iShares U.S. Dividend and Buyback ETF, is built on the idea that dividends are only half of the return equation. The other half is share buybacks. And most income-focused ETFs ignore that second half entirely. This is where your judgment needs to re-anchor. The criterion isn't yield. The criterion is total shareholder return, divided between income you receive today and ownership value that grows quietly over time. Let's get into what DIVB actually holds and how it works. DIVB tracks the Morningstar U.S. Dividend and Buyback Index. That index selects for U.S. companies with a consistent track record of returning cash to shareholders through both dividends and share repurchases. Not just one, both. The result is a portfolio of large-cap, financially stable companies, businesses that have the cash flow and balance sheet discipline to sustain two forms of shareholder return simultaneously. Now, what does a share buyback actually do for you as a long-term holder? Here's a concrete way to think about it. Imagine a company has 10 million shares outstanding. Over 5 years, it steadily buys back 2 million of those shares. Now, there are 8 million shares in circulation. If earnings stay flat, each remaining share now represents a larger portion of those earnings. Your dividend per share increases not because the company earned more, but because there are fewer shares to distribute earnings to. And the underlying value of each share you hold grows accordingly. An investor who understood this mechanism held their position through the entire buyback period. They watched both their income and the value of their holding increase without adding any new capital. They didn't feel the compounding happening in real time. But when they looked back 5 years later, both numbers had moved quietly and steadily. That's the mechanism DIVB is designed to harness. So the first structural strength of DIVB is this. It doesn't select for high yield. It selects for financial discipline. Companies that consistently pay dividends and buy back shares are companies that have made shareholder return a structural priority, not just in a good quarter, but as an ongoing, repeatable commitment. That's a different quality signal than a high-yield number sitting on a comparison screen. Now let's look at where DIVB fits poorly, because that's equally important to understand. DIVB's yield is lower than many dedicated high-yield dividend ETFs. If you place it side by side with a fund specifically designed to maximize current income, DIVB will look modest in that column. This creates a predictable investor reaction. Someone comes in expecting a strong income payout, sees the yield number, feels underserved, and exits before the full picture has time to develop. But that reaction is based on the wrong criterion, being applied to the wrong fund. DIVB isn't built to maximize what you receive today. It's built to position your holding for growth in both income and value over a longer horizon. The lower yield isn't a flaw in the design. It's the cost of holding companies with the discipline to also repurchase shares. Companies that are choosing long-term shareholder value creation over short-term payout maximization. Coming back to the question that sits at the center of this, is DIVB the right structure for your situation? That depends entirely on how you frame the goal. If you need income to cover regular expenses right now, the yield will likely feel insufficient for that purpose. If you're building a position you intend to hold for 7 to 15 years, the structure starts to make a different kind of sense. There are two other constraints worth understanding clearly before you allocate. The first is geographic concentration. DIVB is a U.S. focused fund. It does not provide exposure to international dividend payers, emerging market equities, or diversified global income streams. For investors who want geographic breadth alongside dividend exposure, DIVB doesn't offer that balance on its own. You would need to pair it with other instruments to achieve meaningful global diversification. The second is sector weighting. The index methodology tends to produce heavier concentration in sectors with strong buyback cultures. Financials, technology, and consumer staples often feature prominently in the portfolio. If you already carry concentrated exposure in those areas through other holdings, adding DIVB may increase that concentration rather than diversify it. That's not a reason to avoid the fund, but it is a constraint worth mapping against your existing positions before you commit. On the cost side, DIVB is competitively priced. The expense ratio is low, which means the drag on long-term returns from fund costs is relatively contained. Over a 10 or 15-year holding period, even small differences in expense ratio compound meaningfully against you. A low-cost fund delivering moderate, growing returns will frequently outperform a higher-cost fund with a higher stated yield because the cost drag never pauses, never takes a quarter off, and never stops working against your position. So here's where this lands. DIVB is not a fund you hold because it pays the most. You hold it because you believe that companies returning capital through both dividends and buybacks are compounding your position in ways that yield comparisons simply don't capture. That belief is a judgment, not a fact, and it's one you need to make clearly and consciously before you commit capital to it. If your investment horizon is long, if you're comfortable with a lower current yield, in exchange for a position that builds in both income and underlying value over time, DIVB fits that framework. If you need income to meet near-term obligations, it probably isn't the right tool for that specific purpose. The most honest summary of DIVB is this: it rewards patience, not because outcomes are guaranteed, but because the structure itself dividends, plus buybacks, financial discipline, low holding costs, is oriented toward the long game. And if your investment plan is built around the long game, that orientation matters more than any single yield number on a comparison chart. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.